Well, it's about a minute up, but we're going to get started. I hope everybody's having a great day. My name is Michael Brohant from ITM 21st, and welcome to the webinar, Permanent Life Insurance Policy Purchase Process. That's a mouthful. I'm happy to have Barry Flagg with us for our session today. I'm looking forward to a great session. But first, some quick housekeeping. There are a couple of PDFs on the website. One is for the PowerPoint, three to a page. And one is a document for the best practice standards for life insurance, which we'll talk about in a minute. And if you did not get either of these, they're on the website under education at itm21st.com. Today's session gives 1 hour of CE for CFPs and CTFAs as well as FIRMA members. And the form for that is also on the website. Last, we want you to ask questions, and you can type them into the box on your screen, and we'll try to get them during the session or at the end of the session. Having trouble moving my screen. Okay. A quick note on the upcoming sessions. On April 24th, Kim Nadovich, a long-term care specialist, will be here, and this is really a hot-button topic right now with your clients, long-term care. On May 30th, Randy Popple, who's always a hit, will be here to talk about estate planning strategies for 2018. And on June 28th, Aaron Hansen, who has done a great job in their remediation department, will head up a session that talks about how you can save yourself some heartache and some money. I want to also mention the Tolley Handbook, which is a resource that will be out on the internet. We're targeting the end of May, although a few of the chapters had to be rewritten because of the new tax law. But this will be a handbook for those of you dealing with life insurance in a Tolley setting. It's about 18 chapters, and it'll be all-encompassing. It'll be on the website and will be available to you hopefully by the end of May. We want to accomplish three things today. First of all, we want to explain in general the process of obtaining life insurance. And many trustees really don't have a clue about this process, and that's why we're doing this session today. And you'll see how the process can greatly affect the pricing and ultimately the policy success. And secondly, we want to support the first goals with the background information. And then we want to bring an expert in, Barry Flagg, to talk specifically about developing a prudent process for purchasing life insurance, as our audience is primarily made up of trustees and fiduciaries. One of the handouts today is the West Point Draft, Best Practices for Life Insurance Stewards, and Barry was instrumental in the development of this document, and I did take part in a meeting at West Point where the draft was completed. But for Barry, it really speaks to his life insurance practice and his background. And we put this out there to show a real process if you work your way through it, because having a process for the prudent selection or retention and proper management of life insurance as an asset class can save clients thousands to hundreds of thousands of dollars. And I want to bring Barry in now. Barry, most everyone I talk to says they have a process, but how do you know if and when a process is designed to support fiduciary duties and serve the client's best interests?
Thanks, Mike. Can you hear me?
Yeah, I can hear you good.
Mike, can you hear me? Okay, good. My background started in the fiduciary space first, and I was a pension investment advisory analyst for a full-service financial planning firm. And so my indoctrination to the financial services business was in the fiduciary space and about the fiduciary process. And as I sought to diversify my experience and expand my resume, I went to go work for a life insurance agency who also had a process, but those two processes could not have been more different in my experience. At the risk of stating the obvious, what you want to look for in the process is how you apply to life insurance the elements of the fiduciary process that anybody who's already a trustee, anybody who's already an RIA or a fiduciary already knows. Notably, the two big things that we'll talk most about today, the two big omissions or three big omissions between the two processes, and I often call them two different operating systems. The three big differences between the life insurance industry operating system or process and the prudent investor industry operating system or process is there is an entire section devoted to costs in the prudent investor process. Wasting beneficiaries' money is inherently a breach of duty. So examining and justifying costs, that doesn't mean the lowest cost. It just means that costs need to be appropriate or justified relative to what the intent of the trust is. And performance, and we're going to talk a fair amount about performance, really vetting what is reasonable to expect in performance. And the third kind of disparity between the two processes is trustees, fiduciaries generally have a non-delegable duty to exercise reasonable care, skill, and caution. And I know Mike's going to talk a little bit about this later, but the principal output from the life insurance industry are these illustrations and the comparisons of these illustrations. And there is now guidance from the chief regulatory body of the financial services industry, the chief actuarial body of the life insurance industry, and most notably for trustees, particularly OCC trustees. The OCC updated their handbook for unique and hard to value assets to add a chapter for life insurance. And that chapter says that these illustrations are subject to a high degree of fluctuation and therefore not a very reliable measure of which product is better. The Society of Actuaries in their study concluded that comparing these illustrations are not just inappropriate, but fundamentally inappropriate. And the chief regulatory body of the financial services industry issued a rule saying that comparing these illustrations without talking about costs and performance, just comparing the hypotheticals is misleading. And so as a fiduciary with a duty to exercise reasonable care, skill, and caution, I would not want in my files an illustration comparison that's now considered misleading, fundamentally inappropriate, and unreliable by three separate industry authorities.
So one thing we're going to do, and for some reason I'm having a lot of trouble here. Oh, wait a minute. For some reason I'm having a lot of trouble here today. I apologize. So in order to track or to create a track to run on for our discussion today, I've kind of laid out the purchase process, and we'll walk through this generally to help aid in our discussion. The first, you want to determine the policy type, and we'll then get into a discussion of sales illustrations that Barry touched on. I know Barry has a lot to say here, how they're used in the sales process. Then we'll talk about something that's very important, the cost, and often they're driven by the underwriting. The process is vitally important. I'll talk a bit about that, and then we'll talk about policy delivery at the end. But we're really leaving out policy performance and tracking after the fact because, quite frankly, a lot of the webinar sessions revolve around that, the sessions that we do. So we know how important that is, but the actual maintenance of the asset is not going to be the focus today. The focus today is going to be on the purchase process. And we're talking about policy types, and we have a listing here that includes the generic permanent policy types. And understand that there are variations on policies, but many of the characteristics ring true across each policy group. And understanding the different characteristics when you select a policy is crucial. In fact, I think it's the lack of understanding of policy characteristics that can doom the policy's chances for success from the beginning. So one of the most important characteristics is investment risk. And we're dealing with permanent life insurance with cash value, and the type of assets that are backing the cash value determines the investment risk. And in our chart above, the guaranteed universal life policy is on the left. That's premium driven. You pay the premium and the death benefit's guaranteed. It's like term insurance. There's no real investment risk. And as you move left to right, the risk it increases. Whole life and current assumptions, universal life policies are fixed investments. Index policies, though they're tied to an equity index, are really a type of fixed policy. And variable life has the greatest upside, but also the greatest risk because of the exposure to equity. So a question for you, Barry. The selection of policy types should be based in part on client risk temperament, but how do you assess the client risk temperature in life insurance when the client policyholder is the trust and the trustee's allegiance is to the beneficiaries and not the grantor, who's effectively the client to the trustee or in the trustee's eyes? And how do you then relate that client risk temperament to each particular policy type?
Good question. So most life insurance trusts are unfunded or naked trusts. And so the only source of funds to pay the premium is going to be the grantor. So this is more a matter of logic than it is a matter of a case that I can point to. But if the only source of premiums, only source of funds for payment of premiums is the grantor, then I would argue the grantor's investment temperament or risk profile is the governing risk profile. In the same way that if the trust had assets and the assets were just enough to cover premium payments, you would not allocate those funds to an aggressive asset allocation where there would be a risk of loss. You would make sure that you allocated to a conservative risk profile. So similarly, if the grantor has an unwillingness to make additional gifts to the trust, then I think the trust has to have a conservative risk profile, because if it doesn't, if it allocates aggressively and the aggressive asset allocation has more volatility and that triggers a premium call, now you've got a problem. Because the grantor has already said that they're unwilling to make additional gifts. Conversely, if the grantor says, "Look, I'm fine making an additional gift. I just want to pay as little as possible along the way," an allocation to more aggressive, allocating cash values to more aggressive asset classes that have historically produced a higher rate of return, not guaranteed, but historically produced a higher rate of return over time. The higher the rate of return, the more that those earnings can cover future cost of insurance charges, and the less that the grantor would have to put in. But in a market downturn, he might have to kick some money in. So there's a risk of a premium call. So I would say that the trust's risk profile is a derivative of the client's risk profile and their willingness to make additional premiums. And then that translates to really, as Mike said earlier, there are each of these policy types that we have on the screen have different characteristics, but they also all have a common characteristic. They all have costs. They all have cost of insurance charges and expenses, and they all have an investment rate of return or some rate of return that will be earned or credited on policy cash values. And that latter part, what the cash values are actually invested in, that is the defining characteristic of each product type. There are also some contractual features, like on guaranteed universal life and whole life. There are some contractual features that also define the product type. But the most influential characteristic of each product type is what are the invested assets, underlying cash values actually invested in. So then matching up the risk profile of the trust derived from the grantor and the asset allocation and the corresponding asset allocation of cash values for the product type, that would be how I would relate client risk temperament to each particular policy type.
Well, I have never had so much trouble moving my darn screen. I apologize, everyone.
Every time you pause like that, you make me think like I said something wrong.
I apologize. So, well, hand in hand with this investment risk is the cash value growth, and so similar to what we had before with the investment risk, the cash value growth, as you move left to right, the expectation of that cash value growth is going to increase. And again, guaranteed universal life policy that has low to no investment risk also has minimal cash value, and the policy will stay in force even with no cash value as long as you pay the premium. And then as you move to the right, the cash value is going to grow typically as you move to the right, or at least the expectation of cash value is going to grow. But Barry, at ITM 21st, we've seen firsthand that the actual rate of return credited to policy cash values obviously has a great influence on the performance of non-guaranteed policies, but the rate of return expectations of clients are often very overly optimistic, leading to future client letdown and, as you mentioned, the premium increases. So what can trustees and advisors do to protect against the client disappointment?
Couple things. So first, you got to get underneath the hypothetical values, the hypothetical policy values in the illustrations, whether it's an in-force illustration or a new business illustration or a sales proposal. You got to get beneath the hypothetical premium, hypothetical cash values, hypothetical death benefits, and ask for what are commonly referred to as the detailed expense pages. Each carrier has its own name for these pages, but generally speaking, they are the pages that show the math that's behind the calculation of policy cash values, and examining what that illustration is showing as the interest or the earnings being credited to policy cash values. In some cases, you will be astounded at what you find. You will find in some illustrations that on top of the column headings above the cash value columns, it'll say some number like 5%. And then if you actually look at the actual interest being credited to the policy, that amount is in some cases dramatically higher than 5%. And then there's some footnote on page 632 in 8-point font that explains how they actually do that. But examining what is actually being, what the carrier is assuming is going to be credited to that policy is important for a variety of reasons. That's one of them. The other is relating what the policy is actually crediting to actual historical performance for invested assets underlying cash values. And so that gets back to our risk profile and corresponding asset allocation conversation. Whole life policies and universal life policies, even indexed universal life policies, are required by regulation as a practical matter to invest assets predominantly in high-grade bonds and government-backed mortgages. So simply looking up on the internet or in an investment service, many of you have also serve as trustee on investment trusts. What's the historical historical rate of return for high-grade bonds and government-backed mortgage asset classes? And then is that consistent with what's being shown in this illustration, or is it something different? And if it's something different, that doesn't necessarily mean it's wrong, but it does mean that it would be prudent to ask a few more questions. And then on the other side of the spectrum, if it's a variable policy allocated 100% to equities, which is not being done quite as much nowadays, but if it was, what's the historical performance of the S&P 500, and what's the actual or what's the insurer's assumed return that they're going to credit to policy cash values? Again, not looking at the rate of return at the top of the page, but looking at what's actually being credited in the calculation of cash values. Is that consistent? Past performance is no guarantee of future results, but it's what the investment business uses as at least a first step in measuring or ascertaining the reasonableness of a performance expectation. And so I think it would have saved a lot of the problems that Mike referred to with overly optimistic performance assumptions that didn't come true.
A couple of other characteristics we want to look at here. These are the characteristics you're looking at when you're thinking about purchasing a policy. These are the types of things you're going to walk through with the client. And the first one is premium flexibility. And again, a guaranteed universal life policy is on the left because it not only has minimal market risk and minimal cash value, but it also has minimal premium flexibility. The premium has to be paid each year, unlike most other universal life contracts that have flexible premium. And so this is another important consideration when choosing a policy type. Is there the cash flow that's needed? Now, is there the cash flow? And then even after, retirement, is the cash flow still going to be there? And then while guaranteed universal life premium and even whole life is inflexible, it comes with a death benefit guarantee that most other universal life policies do not have. At least these policies have death benefits that can be for a lifetime. And that's where the flavors of life insurance come in. You can have a universal life policy like a variable or index life policy with a death benefit guarantee for a limited and typically specific period of time. So you have these variations of policy types, and you need to be aware of them and understand the nuances of these various policy types. But this flavor concept has had a negative connotation in the life insurance world among those of us who attempt to purchase life insurance prudently, as in flavor of the month, where when fixed rates were high, your current assumption policy was the one that people wanted to purchase. And then when equities got hot, the policy could be replaced with a variable life contract. And now we're seeing the hottest product in the marketplace is the index UL policy, which is replacing the variable life contracts after the 07-08 meltdown. And it may be that this makes sense in certain situations, but too often we at ITM 21st see the purchase or replacement process beginning with the latest, greatest flavor of the month product. As I mentioned, right now it appears to be Index UL is the savior product. And this is somewhat similar to what happened in the Cochran versus KeyBank case, which, Barry, I know you've written about on a number of publications. And in that case, there were a series of replacements and a number of perceived issues. So talk about the differences you see between the life insurance industry operating system you mentioned versus this prudent investor industry operating system. And what do you mean by these two different operating systems?
Sure. So I'm going to frame the answer with a little bit about the Cochran case for those who don't know or aren't familiar with the specifics. So Mr. Cochran started out with $4+ million of universal life and whole life. As I mentioned a minute ago, universal life and whole life policy cash values have to be invested by regulation as a practical matter in high-grade bonds and government-backed mortgages. So from a prudent investor perspective, that is a conservative asset allocation. That's a conservative risk temperament. In the 1990s, as Mike mentioned, when the stock market was going gangbusters, the dot-com boom was booming. The agent proposed to the grantor first that he exchanged the universal life and whole life policies into a variable life policy under the presumption that he could double his death benefit with, quote, no additional costs, unquote. Of course, that's not a precise use of the term costs. What he meant was there was no additional premiums, because as Mike alluded to before, there has been a penchant from the life insurance industry operating system to use overly optimistic assumptions in the illustrations, which can hide, because the more the earnings, the more it can cover costs, and that can cover high costs. So they switched from $4+ million whole life universal life to 8 million variable life. The dot-com boom turns into the dot-bomb bust, cash values declined by $37,000, which actually was a very reasonable performance for an aggressive asset allocation. I forgot to mention cash values of the whole life or the variable life policy were allocated to 100% equities, including emerging markets and small caps. So an aggressive or even ultra aggressive asset allocation, which from a prudent investor perspective, we would want to have asked some questions along the way. How did we go from a conservative investor temperament or a conservative risk profile to an ultra aggressive risk profile inside the period of 30 days? You fast forward another couple of years, the cash values decline. The agent goes back to the grantor and says, "This is too risky for life insurance. We now need to get out of this." They propose a $2 million guaranteed universal life, which, as Mike alluded to, was the flavor of the day in the 2000s. And to the trustees' credit, they did two things that were really important. They had the beginnings of a process, and they sought information from an independent source without any economic stake in the outcome. And the trustee concluded that so long as the $2 million death benefit was consistent with the grantor's intent, that this was a prudent thing to do. Of course, as Murphy of fame, Murphy's Law would have it, Mr. Cochran died 7 months later, and the beneficiaries who 7 months earlier had an $8 million death benefit were now getting a check for $2 million, and they sued for the difference. So the things that the differences between the prudent investor industry operating system and the insurance industry operating system that are highlighted by this case are some of the things we've talked about. One, the premium is not the costs as was presented in one of the exchanges. Just because it has no premiums doesn't mean it has a lower cost. Understanding the reasonableness of the rate of return as it relates to acceptable levels of risk for the trust and by derivation the grantor, and avoiding these hypothetical comparisons that don't get into costs and don't get into the performance assumptions and that are considered misleading, fundamentally inappropriate, now are considered misleading, fundamentally inappropriate, and unreliable. Those are the three big takeaways, three big things I take away from this case as the differences between the prudent investor industry operating system and the life insurance industry operating system.
Thanks, Barry. One of the and this is really getting into your area of expertise. One of the greatest misconceptions that I see when I'm dealing with trustees is their reliance on these life insurance sales illustrations. It's what a carrier gives you, so it's what you have to deal with. But first of all, they show a static rate of return all years, which is just never going to happen. I know, Barry, that you have great issues with the use of sales illustrations as a policy selection tool. So what do you think about trustees and other fiduciary advisors having these illustration comparisons in their files, and what are the alternatives here for using a hypothetical comparison?
So it's probably already clear to everybody that I don't think having hypothetical comparisons in the trust file is a good idea. A plaintiff attorney has not yet made the argument that you as a trustee have a duty to exercise reasonable care, skill, and caution. So what are you doing with misleading, fundamentally inappropriate, and unreliable documentation in your files? That has not been made yet, but I can't imagine it's not going to be made at some point in time. And so, as Mike said, the illustrations are all the carriers give you, but they actually give you less than what you're entitled to and less than what they have, usually, 99% of the time. Those illustrations, the illustrations that are predominantly provided are the pages that show the hypothetical premium, hypothetical cash values, the hypothetical death benefits, with a bunch of footnotes that protect the insurance company, and don't include any of the information that's necessary for the fiduciary, for the trustee, namely the costs and the performance information. However, those pages are available. I mean, clearly they know what the costs are because they couldn't calculate the cash values without them. So getting those pages at a bare minimum, getting those pages, insisting on them, so that the trustee is protected, and so if someone makes a claim that you've relied on misleading, fundamentally inappropriate, unreliable documents, no, you haven't. You've looked at what Section 7 of the Prudent Investor Act says. You've looked at the costs. FINRA's rule about illustration comparisons being misleading has an exception for if you are actually comparing costs and performance relative to acceptable risk, then it's no longer misleading. So get those pages. If you're going to compare anything, compare the actual cost disclosures from those detailed expense pages of the in-force policy to any proposed 1035 exchange. And then I mentioned I came from the investment business first, where I would do a similar analysis on mutual funds using something like Morningstar, where I would compare costs and performance to benchmarks. And from that experience and from my experience in the insurance business, I founded a company and invented a database that allows us to also measure costs against the universe of peer group alternatives and performance against the universe of peer group alternatives. Although at this stage of the game, just getting the detailed expense pages and having that in your files makes you no longer the hanging fruit. That was not good grammar, but I think you know what I mean.
So that leads into an example I've used in the past, and this kind of sums up a couple of things we're talking about. It kind of sums up the flavor of the month, because this was a variable contract that was an existing variable contract that was replaced by an index UL product that was quote unquote more conservative. And because of the fact that at the same time the replacement was being made, the grantor was lowering the death benefit, the illustrations that the agent put together made it look as if it was a better deal to do this transaction, and the grantor was all for it. When we took a look at it, and this speaks exactly to what Barry's talking to, when we took a look at the actual cost for the actual death benefit, apples to apples death benefit, the existing policy had $611,000 of cost over what would be the expected lifespan of the policy, whereas the new policy had almost 2.6 million, 4 times the cost. So, Barry has mentioned this, one of the requirements of a trustee is to make sure that your costs are aligned and your costs are correct. And so this is an example. It kind of speaks directly to what Barry's talking to. But in that case, there was a change in the underwriting. That's what really tipped us off. And we'll talk about underwriting in a second. The policy was a second to die policy, and the underwriting on one of the individuals had deteriorated between the original and the new policy. And trustee has to be aware of that. And I do agree, surely, that costs are a better differentiator than how well a policy illustrates that can be totally manipulated. But Barry, are costs really that different between different insurers or different product types? I mean, aren't all insurers using the same mortality table, where the number of 50-year-olds, for example, who die in a given year is the same for all? Or is the difference in cost due to something else like commissions or something like that?
So some of both. This question about are costs really all that? Can costs really be that different? Is one of the questions I get asked more than any other. And at one time, I had a pretty sophisticated buyer, high net worth individual, and their fiduciary advisors sitting around, and they could not believe the cost differential. And so I said to him, "Well, have you ever seen these costs before?" And so here's a guy who's worth tens of millions of dollars, and he's got CPA, tax attorney, and trust officer around him, and none of them had ever seen the cost before. So I asked him a simple question. I said, "So if you guys, who are among the more sophisticated financial people around, if you guys didn't know what the insurance company was charging, how much do you think the insurance company will charge?" and I don't mean that in a malicious way, that the insurance companies are being malicious. I mean, it's just that as Adam Smith would say, the invisible hand of the consumer can't pick between good and bad pricing, and so the invisible hand of the consumer doesn't give any credit to the carriers that have good costs, and it doesn't penalize by not buying carriers that have high costs. In addition to which, there are lots of different mutual funds, and the price disparity is not as big in the various mutual funds, in part because the costs are much more transparent in mutual funds, and in part because there's fewer of them than the literally 10,000 different prices for the 10,000 different combinations and permutations of factors that go into life insurance pricing. There's a different price for every age, times 2 for gender, times 2 or 3 for non-smoker, smoker, and never smoker, times 5 for health risk class, times 5 more for the different volume bandings on different discounts on bigger face amounts, times different commission discounts on or no load products. So there are 10,000 plus different pricing combinations and permutations, and too few people know what's actually being charged to make it an efficient market. So there is as much as an 80% swing, 80% swing between best available rates and terms and worst available rates and terms for a given pricing cell. Of that, cost of insurance charges are far and away the largest cost element, comprising 80 to 90% of total costs, and commissions or all other expenses, which includes commissions, comprise the other 10 to 20%. So commissions can certainly have an impact on the difference price between different carriers, but the biggest impact or the biggest differentiator in price is which product has the lower cost of insurance charges in that given specific client situation.
So the discussion of costs is right to the heart, and it's extremely interesting. But Barry, in this day and age, it seems that everything in the financial services seems to be increasingly transparent. You have commercials on TV about the cost of mutual funds, which have dropped dramatically. You have 401k lawsuits about costs. So you have this fee compression everywhere where costs seem to be going down. So why is there still such a wide difference in costs charged by these different life insurance carriers and among the different insurers? And how does a trustee really figure out which carrier is going to have the lowest costs?
So I call this the flashlight, the ruler, and the bag of money exercise. Yes, transparency is increasing, but it is not even in the 401k world. It's not perfectly transparent, which is why the 401k lawsuits are going on right now. The 401k world is night and day better than it was 20 years ago, but it's still not perfectly transparent. And the life insurance business has a long way to go even to catch up to the 401k world. So while there is a general increase in transparency, it still takes the trustee or the buyer or the advisor, the financial advisor or the sub-advisor to the trustee, to request from the insurance company the detailed expense pages so they can shine a bright light on them. Then step 2 to really make sure that you've got the lowest cost is get a ruler out and measure those expenses against industry benchmarks for either industry averages or best available rates and terms. And then one of the values that I think trustees aren't bringing as often to grantors as often as they could is, given this considerable disparity between best available rates and terms and worst available rates and terms, getting the flashlight out and shining a bright light on what those rates are, getting a ruler out and measuring whether those costs are competitive or excessive, and when they're excessive, getting out a bag of money and working with a sub-advisor to capture those cost savings and then give them back to the grantor, or at least let the grantor know that, you know, we in performance of our duties and in professionally managing this asset the way other assets are managed, we found this money for you. Would you like to use this money to reduce the gift that you're making to the trust, to increase the death benefits, to maybe make up for some underfunding, to kind of reseed the policy, to maybe pay some trustee fees. But you got to get the flashlight out and shine the light on it, because life insurance is not yet as transparent as other segments of the financial services business. Getting the ruler out helps you find excessive charging, and when there is excessive charging, that's the opportunity to add value back to the grantor. And you know, arguably, I think you could charge more for something like that. I think that's probably coming at some point in time.
So we've talked about policy type, talked about characteristics, the value or the lack of value of sales illustrations. We also talked about policy costs. Now, I want to touch real quickly on underwriting, because it can certainly affect cost, and good underwriting is imperative. So a couple of things. First of all, underwriting is health oriented, but it's also typically financial also in the estate planning arena, because you have to justify the death benefit. And one thing you should know is that if you have a client, you can get an informal offer by filling out a short HIPAA form and allowing an underwriter to gather information on your client and give an informal offer as to whether they'd be a standard risk or a preferred risk. So to get a formal offer and to get a policy, your client's going to have to undergo a paramed exam where someone's going to come out, draw blood, get a urine sample, and maybe even get an EKG or something like that. And one of the things I want to get across to people is this is very important. The paramed exam is very important. And if you have a client that's getting a paramed exam, the agent should be providing that client with a list of things they should or should not do. And some of these things are listed on the screen. Relax, get a good night's sleep, have all the doctors and prescriptions listed, so your client can just hand that to the paramed. You're going to fast before the exam. You're going to want to do an early morning exam before you get too excited. And also, because you're fasting, it's easier. Don't smoke before the exam. Don't even exercise for a day or two before the exam. And then limit nasal decongestions, alcohol, coffee, and salt. And it's very important, because one of the things that can happen in the underwriting process, you're going to have the health records, you're going to have the paramed exam. And a good paramed exam can overcome some of the issues that may have been there in the health records. But a bad paramed exam can also hurt you. And again, this is going to help drive the pricing. So a good paramed exam is going to help the underwriting game. It's going to save your client some money. And Barry, I often hear from life insurance practitioners that the underwriting process can vary widely from one carrier to another, and has a great influence on policy pricing. And is it true that the underwriting process varies between insurers, and how much of an impact does underwriting have on these internal policy costs that you talk about, specifically the cost of insurance?
So yes and no, and then a lot or not much. So let me see if I did that right. If there are issues in the health profile that some insurance companies just don't have the statistical data to be able to come up with a price, certain conditions, maybe conditions that are kind of outside the mainstream, then there can be huge differences between underwriters. It can be one insurance company may say, I decline to make an offer at all, and that's because they just don't have enough data enough claims data, enough actuarial data to be able to then price something for that condition. There's too much uncertainty. Other insurers may have a lot of experience with that particular risk factor in someone's health profile, and I've seen as literally cases where one insurer has declined to make any offer at any price, and another insurer has offered standard rates. So a bad underwriting offer does not necessarily mean that the client is in bad shape. It may just mean that you may not be talking to the right insurance company. So it is really important to understand the universe of peer group products. Once you've gone through the what would be actually step 3 of the West Point draft of best practice standards. Once you've strategized the product type, you understand the client's risk profile, the asset allocation preferences that correspond to that risk profile, the time horizon, and the expected rate of return. Once you understand those 4 factors, which, by the way, those 4 factors are an acronym RATE, which then determines the rate of return that would be reasonable, or that is a good way to remember the rate of return that's reasonable to expect. And the rate of return that's reasonable to expect, and the asset allocation drive product type. So once you figure out what product type, then understanding the universe of peer group alternatives, and then going to the provider of best available rates and terms, and getting an underwriting offer from them, and going to if they say we can't give you our best rates, then going to the second best provider of best available rates and terms and asking for an informal rate offer, and likewise down the line until you find a carrier that can give you the best rates. And if you can't find one that gives you their best rates, then at least you have a prudently selected universe to then pick from, so that you can document your file that underwriting won't have made a difference in your case. In the cases where there's not something really problematic for an insurer in the a risk factor that's problematic for an insurer in the health profile, underwriting, the difference between preferred and standard is typically about 8%. The difference between preferred and preferred plus is typically about 8%. So unless there's something that's problematic, underwriting can certainly be icing on the cake, but you want to find the carrier that offers the lowest COI, so that you're not getting a preferred offer from the provider of worst available rates and terms, which is 80% higher than the provider of best available rates and terms. And you might be getting an 8% discount for preferred, but you're still now 72% higher than the provider of best available rates and terms, kind of thing. So find the low COIs, go through a methodical process, find the provider of low cost insurance charges, go through a methodical process of getting underwriting offers. And if you can get one to give you better than the other, that's great. And if some don't give you anything at all, then you're still covered.
And let me just throw in there that this is where working with a good underwriter makes a lot of it creates a lot of value. I came from the brokerage world. I happen to have worked with a gentleman who was a fantastic underwriter. And if you have a good underwriter, they know which carriers are best for each particular situation. And I've actually seen underwriters who were so good, they went in and looked at doctor records and realized that parts of the doctor records were incomplete or were wrong, and actually went back and corrected things and got better underwriting offers. So the underwriter can be your best friend when you're attempting to get good costs. And once that underwriting's done, that's the rate you're going to be stuck with. So, Barry, I want to talk a little bit about delivery requirements, just accepting the policy. What are the things that a trustee should look for at this time to make sure that all is in good order when they're accepting a policy?
So, I mean, the usual things, making sure that the spec page of the contract match up to the illustration. While I have said ad nauseum that illustrations are misleading, fundamentally inappropriate, and unreliable for comparison to another one for product selection purposes, the illustrations contain very valuable information, particularly if you've asked for the cost pages, or when you've asked for the cost pages, because it's such a good idea. So comparing the spec pages, or reconciling or quality controlling the spec pages to make sure that the policy was issued in accordance with expectations, with original expectations. I will say that it is difficult, particularly if you're doing a replacement. And by the way, just to be clear, Mike showed an example of a proposed replacement that was not in the client's best interest. My cautionary comments about the use or the misuse of illustration comparisons in replacements, none of that is intended to convey that replacements cannot be in the best interest of the client. Back to my comments before about flashlight, ruler, and a bag of money. There are insurance companies that are charging more than the trustee can justify, and so understanding when a policy is charging excessively and capturing those costs can be a very, very a replacement that is certainly in the best interest of the trust and the trust beneficiaries. But if you're doing a replacement, then you'll be moving an account. You'll be moving one policy account from one insurer to another insurer. And that the amount that gets moved over is never as it was originally illustrated. So making sure that the amount that actually comes over is at least sufficient to make sure things work. If it takes a long time to do the exchange, the old insurance company is deducting those high costs out of the value, and that can mean that less comes over and some adjustments need to be made. So verifying that 1035 amount is maybe as important as anything. That the transfer amount is maybe as important as anything. And then I would also, I think it's a very good idea to check back in with the grantor and when it's appropriate, the beneficiaries, to make sure that what actually has now happened. I think ITM uses what's called a statement of understanding. That here's what we expected to happen, here's what's actually happened, and getting sign-offs, I think, is just a very prudent thing for the trustee to make sure everybody's all on the same page.
And that's a great point about the 1035 exchange. We've come in on the back ends, taken in policies where people did not understand why the policy wasn't performing as they expected, and it was in the early years, and the reason was the 1035 exchange was off. So we've walked through different parts of the policy purchase process, and I know that for some trustees, it's hard to understand all aspects of this. And one of the possible keys is to have an advocate for the trustee and the grantor. And we've talked about fiduciary duty today, and obviously doing what is right for the client. The beneficiary is the key to this process, and the trustee has to believe that the advisor on a policy purchase or replacement is an advocate for the trustee and the beneficiary. Just like I talked about, even having a good underwriter can be an advocate for the trustee and the beneficiary for purchasing that policy. And Barry, I know that your insurance practice is focused on the prudent selection and proper management of life insurance. Talk about what a trustee should look for if he or she is looking to someone to be an advocate for the life insurance purchase. What should a trustee look for?
So it's really the combining, if you will, of two skill sets. I mean, the asset that we're talking about managing in a life insurance trust is a life insurance policy, and so having an understanding of what a policy is. What its elements are. I don't think the trustee should have to know what a paid-up addition is necessarily, but certainly the sub-advisor to the trust needs to understand, all the elements of a life insurance product. In the same way, I mean, I think about this again since I came from the investment world first, and so I kind of analogize the insurance world to the investment world. The same trust companies who serve as trustees on life insurance trusts, they also serve as trustees of investment trusts. But that doesn't mean that the trustee is picking stocks. The job of the trustee is to understand the grantor's intent, the terms of the trust document, the applicable laws in the state of domicile, and ideally some relationship with the beneficiary, so the assets don't walk out the door when the grantor dies. But the trustee is not picking the stocks. An investment advisor is almost always assigned to the investment trust, so that the investment advisor can review trust assets, and they may know, some whiz-bang feature of a hedge fund that the trustee may never know, but the trustee is going to get the information that is necessary as it relates to their duties. What are the costs being charged? What's the rate of return that's reasonable to expect? Are there any particular special features that satisfy or that correlate with the grantor's intent? So I think you got to look beyond just life insurance knowledge, and for someone who also has a familiarity with fiduciary principles. And I think it's kind of come full circle. Mike mentioned at the beginning of his remarks this West Point draft for best practice standards of managing life insurance as an asset. It's only about 8 pages, so it's not an onerous document. It's really more of a checklist for a trustee. But it goes through, and some of the things may be more relationship management type stuff. Step 1 talks about conflicts of interest and putting a team together. But the big ones that we talked about today are in the West Point draft. And so you've got a checklist, is the life insurance advisor that I'm considering relying on in the same way, relying on my behalf, not on the client's behalf, but on my behalf, is the life insurance advisor giving me the cost information like the investment advisor gives to the investment trustee or the investment trust committee? Am I getting commentary? Am I getting analysis of the rate of return that's reasonable to expect from this asset, not just taking the hypothetical that comes from the illustration, and definitely not comparing one hypothetical to another hypothetical as the presentation to the trust committee that then goes into the trust file. And again, this hasn't happened yet, but if I were a trustee, I'd be scared to death about a claim of breach of my duty to exercise reasonable care, skill, and caution for having misleading, fundamentally inappropriate, and unreliable due diligence in my file.
Thanks a lot, Barry. Do you have any final thoughts? Almost to the top of the hour, but do you have any final thoughts?
I'm almost out of breath as it is, Mike.
I got one quick question. Shoot. That came in. So the question is, how do you deal with the wide range of costs in UL depending on minimum and to maximum cash value? And I think what he's speaking to, and I don't know whether we even really have an answer for this, is that if you have a universal life policy with low cash value, your net amount at risk is the difference between the death benefit and the cash value. The higher that net amount at risk is, the lower the cash value is, the higher the net amount at risk is, the more cost of insurance you're going to be charged. So I think that one of the parts of the question is, how do we deal with that? And rather than answer it, what I would say to trustees out there is it's something we have to really keep an eye on as a client ages, because in a policy, a permanent life insurance policy, the cost of insurance goes up each year on a per thousand basis as we age. So if you're going to allow the cash value to dissipate in a policy, and now the client is 80, 82, 85, the cost of insurance, if they're being charged for $1 million policy with $100,000 of cash, is way more than $1 million policy with $900,000 of cash. Because when they die, the carrier is going to keep the cash, so the net amount at risk is minimal. So rather than answer the question, because I don't know really how to answer the question, what I would say is that for trustees, it's something that you have to watch. It figures into this whole cost of insurance aspect. And it's something that as you're managing these policies, especially as clients get older, and believe it or not, we have had clients live to 100, so it does happen, and that's a whole other issue we can deal with on another day. But we're heading to the top of the hour, so I wanted to thank Barry, who is certainly an expert in this field. I want to thank everybody for being a part of the session today. Next month, we will be having a session on long-term care, If you want CE for this session, then fill out the form and send it in. And again, Barry, thank you very much for taking part today. I very much appreciate it.
Always enjoy it, Michael.
All right. Thanks, everybody, for taking part. We'll talk to you next month. Thanks.